AI infrastructure costs are reshaping capital planning. As companies enter 2026, AI strategies are colliding with physical and financial constraints that were only partially visible a year ago. Throughout 2025, enterprise AI adoption accelerated alongside mounting pressure on data center capacity, regional power availability, and supporting infrastructure. Those pressures have not reset with the calendar year. They are now showing up directly in capital planning conversations. What changed in 2025 was not simply the pace of AI deployment, but the clarity of its infrastructure demands. Grid operators closed the year acknowledging extended interconnection timelines in several U.S. regions. Data center developers signaled that high-density capacity would remain constrained well into 2026. At the same time, industry research consistently showed that AI compute intensity is increasing faster than efficiency gains alone can offset, particularly once energy, cooling, and redundancy requirements are fully accounted for. As a result, AI investment is increasingly tied to infrastructure commitments that are harder to delay, resize, or unwind, reshaping how companies think about capital allocation heading into the new year. Energy availability is forcing earlier financial commitments. One of the most immediate pressures is power. AI workloads are driving sustained increases in baseline electricity demand, often concentrated at specific sites or regions. In markets facing grid congestion, limited generation capacity, or long interconnection queues, companies are encountering higher upfront costs, longer timelines, or both. These conditions are changing the sequence of decision-making. Rather than scaling AI first and solving for energy later, organizations are finding that power access now determines where and when AI can realistically expand. That shift pulls infrastructure spending forward in the capital planning cycle and ties AI growth more tightly to regional energy dynamics. For finance teams, this means AI-related costs are increasingly influenced by factors outside traditional IT control, including utility pricing structures, grid investment timelines, and local infrastructure constraints. Data center capacity is becoming a limiting factor. Data center availability has emerged as another structural consideration. Throughout 2025, cloud providers and colocation operators reported sustained demand for AI-ready capacity, particularly for high-density environments requiring advanced cooling and power delivery. In several markets, suitable capacity is no longer assumed to be immediately available. For enterprises moving beyond pilot projects, this has real capital implications. Access to appropriate space can determine whether AI initiatives proceed on schedule, are delayed, or require alternative deployment models that carry different cost profiles. In some cases, companies are committing capital earlier or at larger scale than initially planned to secure capacity. This dynamic extends beyond IT budgets. When AI growth underpins revenue expansion, automation strategies, or competitive positioning, constraints on data center capacity begin to influence broader investment priorities. According to research from McKinsey & Company, global data center investment requirements are escalating rapidly as compute demand accelerates. By 2030, data centers worldwide are projected to require approximately $6.7 trillion in capital investment to keep pace. The majority of that spending, about $5.2 trillion, is expected to go toward facilities capable of handling AI-intensive workloads, while $1.5 trillion will support data centers serving traditional IT applications. Cost structures are hardening over longer time horizons. Unlike software subscriptions or short-term services, AI infrastructure investments tend to persist. Once organizations commit to site upgrades, long-term colocation agreements, dedicated energy sourcing, or specialized hardware, those costs become embedded across multiple planning cycles. That persistence is prompting a shift in how AI economics are evaluated. Rather than focusing solely on near-term deployment metrics or unit costs, finance leaders are increasingly examining lifecycle expenses, depreciation timelines, and long-run operating impacts. This is a meaningful departure from earlier assumptions that AI spending could remain highly flexible. Infrastructure realities are narrowing that flexibility and making reversibility a more important consideration in capital planning. Why this is no longer an isolated technology issue. What distinguishes the current moment is that AI infrastructure considerations are no longer confined to technology teams. The implications now span multiple executive functions: finance, capital intensity, long term commitments, and cost visibility; operations, site readiness, reliability, and expansion sequencing; sustainability, emissions exposure tied to power sourcing and load growth; strategy, alignment between AI ambitions and physical feasibility. As AI adoption matures, infrastructure constraints are increasingly shaping strategic options rather than merely responding to them. Entering 2026 with clearer signals. Many of the challenges discussed in 2024 and early 2025 were framed as emerging or theoretical. By the end of 2025, they had become operational realities for a growing number of organizations. Extended interconnection timelines, constrained data center capacity, and rising infrastructure costs are now intersecting directly with approved AI budgets. Entering 2026, the question is no longer whether AI will require substantial infrastructure support, but how those requirements reshape the financial pathways available. Capital planning is adjusting accordingly, with greater emphasis on sequencing, location strategy, and long-term cost visibility. AI remains a powerful driver of productivity and growth, but as its physical footprint expands, the infrastructure required to support it is becoming a defining factor in how and how fast companies deploy capital in the year ahead. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.